Hello, everybody. Welcome to our monthly webinar for Elevate Wealth Advisory. I'm Betsy Kenyon. I'm the marketing director here at Elevate. And today, once again, we have our director of investment policy with us, Rob Fezekas. Hey, Rob.
Hi.
We're so thankful to have Rob with us, especially on this topic of investing, which is definitely his niche. In our office, we often say WWRD, which is what would Rob do when we have questions about investing. So he is a wonderful resource, being one of our chartered financial analysts on our team. So I will let you take it away, Rob.
All right. Thanks, Betsy. Well, I'm going to go ahead and share my screen now. Okay. So hopefully you can see that. Good afternoon, everybody. Thanks for joining me for today's webinar on investing. We are going to spend, we're going to cover all kinds of aspects about investing, but we'll spend a little bit of time on why people invest and a little bit of time on how people invest. But most of the webinar is going to be focused on what we have learned about investing over the decades. And so it's actually quite a bit, and hopefully we can all take away a few lessons that perhaps we could use in our own investments and our own portfolios. So let me start with just a really basic question, which is, why do we invest? Why do people invest? And there's a few reasons, and probably the most obvious or basic one that springs to mind is we'd like to make some money, and that is absolutely true. We invest with the expectation that our money will grow, so another way to put that is to earn positive expected return. So those two things are really the same thing. It's just that sort of financial professionals are probably going to use that phrase, to earn positive expected returns on our invested money. Interestingly, this is what distinguishes investing from gambling. Both investing and gambling involve risks, which we will talk about in a few slides from now. But with gambling, your expected return is negative. It can be exciting and entertaining, and certainly risky, but we do not expect to make money when we gamble, which is the opposite of investing. So when we invest money, a true investment has a positive expected return, and we do expect our money to grow when we make an investment. Now, another reason to invest our money is to preserve and protect our wealth, especially from the risk of inflation. We know that inflation is going to erode the value of our money over time. So if we don't invest and just keep all our money in our mattress or in a bank account, slowly but surely over time, the value, the purchasing power of that money is going to erode over time. And so investing in something that at least keeps up with inflation, hopefully exceeds the rate of inflation, is one major reason to consider investing our money. And finally, we invest to do a little bit of time travel, which is to shift current resources that we have today toward some point in the future to fund a specific goal. So we might invest for our retirement, which may be years or decades in the future. We may invest to pay for college or any other big financial goal that's out there in the future. So we take some resources today, and instead of spending those resources, we lock them up for a period of time, shifting them from the present to the future. Now, I mentioned before that investing definitely involves risks, and we know that's true. Let me give an example here, looking at the S&P 500 and some return data that goes across a 40-year period from 1980 through 2020. And there's sort of two parts of this graph. One is the blue lines, which are generally on the top part of the graph. This is the return at the end of the year for each of those years, from 1980 through 2020. How did the S&P 500 index perform by the end of the year. So this is the 12-month calendar year return for the S&P. The blue dot on the kind of the lower part of the chart shows what the largest drawdown was during the same year. So one thing that kind of jumps out on this chart is that stocks go down every single year, which is, can be kind of a surprising result to think about, but it's true. Every single year, we're going to have some kind of drawdown from all-time highs. And that's true even in years that end up strongly positive. So if you want to look at, say, look at maybe 1998, kind of in the middle of the chart, there was a drawdown of 21%. So at some point during the year, there was a loss during the year of 21%. However, by the end of the year, 1998, the S&P 500 was actually up 29%. So we know that, like I said before, investing involves risk, and this sort of demonstrates that you're going to experience losses in your portfolio every single year, at least temporarily. And so we just need to be prepared for that and realize that that's normal, and that we expect to see that every year in the market. So not investing means taking risks too. And I mentioned this before, which is primarily the risk of inflation. So we do know, again, that if we don't take the risk of investing and we just hang on to uninvested cash, the value of that will erode over time. We see that with the price of groceries or really anything, because of inflation. Our money today, a dollar today is worth more than a dollar will be in the future. And so we want to at least keep up with that background rate of inflation, and hopefully exceed that, so that our purchasing power grows over time. And that's really the key goal of long-term investing. Is we want to grow our purchasing power so that we actually have greater purchasing power in the future than we do today. So hopefully that's what we can achieve by investing. So those are some of the reasons why that we invest. Let's talk a little bit about how people invest. And there's really, almost an unlimited number of strategies that people employ when it comes to their investing. Some people just kind of go with their gut. They may have a feeling, maybe it's emotional. How does the market feel at the moment? How does the economy feel? Maybe their own situation. Do they feel like they're doing well in their careers? Things are going well financially for them, and they may decide to put more money in the market when things feel good. And then the opposite might be true if it feels like maybe the market's not doing so well, or the economy is not doing well. Maybe they're concerned about a recession or losing their job or something, and they may change their mind and decide to maybe pull back or invest more conservatively. So that's one option. Another is they may hear some information either in the media or maybe from people they know, people they trust, and so they may actually use that to sort of help their investment decisions. They may follow maybe what their friends are doing, or some recommendation that they read about or heard about. Some people are swayed by the media, and if you watch financial media, there'll be no shortage of opinions on exactly what you should be buying and what you should be selling. Now, mostly, if you watch a lot of financial media, you'll notice that what they talk about most of the time is what you should be worried about at the moment. So, which really there's a long list of things that they can point to that you should worry about, and maybe reasons not to be invested at the moment. And that's really because, the financial media is more in the attention business than the sound investment business. So they would like to keep you watching. They want to keep your attention, and fear is definitely a way to sell that. And so they're going to want to keep your attention with all kinds of stories designed to provoke emotions of either fear or greed. And then another one, and this is the last one I'll talk about, is a lot of people try to make a prediction about the future. And this one's really important because this really describes quite a bit of the active management industry. So people whose, mutual fund managers whose job it is, whose task is to try to outperform a benchmark index. A lot of what they do is predicting the future. Now, they're not going to put it that way. They may use other phrase, but they may call it making a forecast. And they may make forecasts on all kinds of things. They might forecast what the economy is going to do, whether it's going to get stronger or weaker. They may forecast what interest rates are going to do, if they might go up or down. They may forecast what the entire market is going to do, if the market's going to go up or down, or maybe they're going to limit their forecast to a particular company that they're researching, trying to decide if they should buy or sell. And so they're going to forecast what that stock might do, or what the company might earn in the next few quarters to try to make that decision. So, predicting the future it's a tough business. And I'm going to show some data in just a second on how difficult that is. But it's a very common strategy that's employed widely today in the mutual fund business. So this method, an active method for choosing investments in a mutual fund or trying to predict the future, kind of looks like this. So this chart here would show what an active manager's portfolio might look like compared to the entire market. So the entire market, if we just look at the US market, has many thousands of individual companies that trade. It's more than 3,000 publicly traded companies in the US. Now, but an active manager may select a very, very small number of those companies to include in their own portfolio, hoping to pick the ones that will outperform. And so that's kind of what this looks like on the chart. Those many gray circles represent all the different companies that comprise the total stock market. And the green dots are perhaps the companies that an active manager will select for their portfolio. And there may only be a couple dozen out of those thousands of names that they choose. And then the red dots will be the companies that they decide not to hold anymore and are going to sell from their portfolios. But you kind of get a sense of just how small the number of companies are that we're talking about relative to the entire market. So it tends to be quite concentrated. And as I mentioned before, this is a tough business, and the data kind of bears that out. If we look at the performance of actively managed mutual funds over a long period of time, and this is just one period, but it's a 20-year period from 2004 through 2023. And if we start our performance review and we look at all of the mutual funds that began that period, and there were 2,860, and then we follow the performance of those 2,860 funds over a 20-year period, we kind of see what happens over time. And the first thing that we see is that actually most of them don't even survive until the end of the period. So only 45% of those beginning funds from 2004 were even still around at the end of 2023. Most of the time, that's because of poor performance. They'll close funds that don't do well and don't attract new money. And then we can also look at what a fraction of those beginning funds actually did beat their benchmark. And that number was 18%. So again, 4 out of 5 did not beat their benchmark return. And so for 4 out of 5 investors in all of those funds, they would have been better off just buying and holding the entire market over that period rather than trying to select a fund that may or may not outperform. And kind of a similar story for fixed income, which is the bond market. So if you, again, track bond market or bond fund performance over a 20-year period, about half survive, and then about 15% end up being winners. So again, tough business, maybe not the best way to choose which funds to hold, but certainly a very, very common way. It's a very popular way to manage money and to invest in mutual funds in the market. So this kind of brings up a question that really everybody should ask themselves, which is, what is your investment philosophy? And that really refers to your set of core beliefs about how markets work and how investors should best participate in those markets. And again, there's almost a unlimited number of investment philosophies out there, many of which can be perfectly successful. But probably the most important thing about an investment, I'll say actually there's two really important things about investment philosophies. One is that you should have one. You should have an idea in the back of your head. What is it that I believe about markets? What is my investment philosophy? And then secondly, you should be able to stick to it, even in periods maybe when your philosophy is not doing particularly well. And that's going to happen certainly from time to time. There's no investment philosophy that works really well in all time periods, but you want one that you can stick to, because if you're constantly changing, when things get a little bit difficult, you're more likely to have high trading and transaction costs and end up not being in the market. Maybe when you'll miss some upside in the market if you're trading and trying to time the market too often. So let's talk about, just for a minute, another approach, which is really the exact opposite of the active management approach that I talked about before. Another investment strategy or philosophy is simply to take a passive approach and just buy an index fund. And there's many index funds to choose from. S&P 500 index funds, very common type. So this is a fund that basically tracks a commercial index and just does everything the index does at the very same time. So there are many S&P 500 funds out there or other index funds that just will track that index and hold the exact same companies in the same proportions. And there's some advantages to index funds. Probably the biggest one is it's very inexpensive. You can buy an index fund for a very, very low management fee, less than 0.1%, maybe even half of that these days. They're approaching free, zero fees on some of these index funds these days. So it's very inexpensive. It's very efficient in terms of trading, not a whole lot of trading, so there's not too many costs involved. And this is a perfectly viable strategy that many people have success with. And I'll show you kind of what that looks like, again, on the same kind of chart. So again, if we look at the entire market, which is all those gray dots, an index list is going to represent a larger number than an active manager, certainly, but it's still just going to be a fraction of the total market number, the number of names in the entire market that are out there. So again, I'll just keep using the S&P 500 as an example. So that's a commercial index that holds 500 companies. And you can compare that to, again, the entire market, which I mentioned before, has more than 3,000 names. So you're getting a representation of the market, but all the companies in the S&P 500 are large companies. And so for the most part, you'll be excluding those sort of mid-sized and small-sized companies that represent the market. But it's a decent representation of US large companies And again, very inexpensive to hold. But this is kind of what it would look like as a relative proportion of the entire market. So let's shift gears here now. We've talked a little bit about why people invest and how people invest, some different kinds of strategies. And so now I'd like to talk about what we have learned over the years about investing, and it's quite a lot because this has been studied now for many, many decades. In fact, one of the very first insights about investing goes back now more than a century, back to 1906, when a scientist and a statistician named Sir Francis Galton found himself at a livestock fair in 1906, and there was a contest to guess the weight of an ox at that fair. Now, Mr. Galton did not enter the contest, but when the contest was over and they announced what the actual weight of the ox was, which was 1,198 pounds, Mr. Galton asked if he could see all the guesses that were made. So there were about 800 guesses that people that had entered that contest. None of them were correct. But what he did was he took all of the guesses and got an average and a median, and found that the median guess was actually very, very close to the actual weight of the ox. It was less than 1% away from the ox's actual weight, only about less than 10 pounds. And so this led to an insight which he wrote about later, called the wisdom of crowds. And it was really sort of the first clue that it was possible that a market can be wiser than any individual participant in that market. And so that insight leads to one of the first lessons that researchers have uncovered about how markets work and maybe how investors should participate in those markets. And that lesson is to embrace market pricing, to trust the market, to do its job. And markets have a couple of jobs. Of course, they exist to bring buyers and sellers together. That's a major function of markets. But another thing that markets do well, especially large liquid markets like like global stocks, either in the US or globally, that trade 24/7, that trade a lot, have a lot of trading volume. One thing that these markets do very, very well is digest information. And so when new information occurs, when the news comes out of some new event, prices can reflect that information very, very quickly. And this is a process that's actually speeding up over time, because most trading that occurs these days is what they call algorithmic trading. So it's really machines trading with other machines, and they're doing this, at a speed that humans could never keep up with, just in the blink of an eye. But it does allow all this trading, all this speed, and all this volume allows prices to react quickly and to reflect what is known about the companies that are trading in a market. And so one thing that we can see, if we look at the history of returns, we see that for investors that have lived that lesson and embraced market pricing, they have been rewarded with really strong returns in the long run. And so if we look back over almost a century of return data, going back to 1926 now, we see that the stock market has definitely rewarded patient long-term investors who just trusted market prices to deliver high returns. And so we see that $1 invested back in 1926 has grown to over $11,000 by the end of 2022. And if you had invested $1 in small US stocks, it's actually grown to more than $28,000 over that time frame. So very strong returns over the long run. And we can compare that to returns of other asset classes, long-term bonds, short-term treasury bills, and then inflation. And so, the one thing this chart also shows is how strongly the relationship is between risk and return. So again, going back to the stock chart, the stock part of this chart, which is at the top two lines, we see strong returns, but you'll see how jagged those lines are. There's a lot of ups and downs, a lot of deep drawdowns, and strong rebounds, and just a lot of movement in those jagged lines. Now that's volatility, and that is risk, right? It's risky to hold stocks because of the possibility of these big drawdowns, and that you can definitely lose money over the short run or even intermediate run in stocks. So we've definitely seen periods where the markets have gone down sharply, and it can be difficult to hold on to your stock investments when you see that kind of volatility. It can be scary. But that's, it comes with the territory. And we can compare those jagged lines to, say, the bottom, toward the bottom, that light blue line that says treasury bills. So that means that $1 invested in treasury bills in 1926 has grown to $22, which is, much more modest in terms of returns. But notice how flat that line is, right? There's hardly any ups and downs. It's almost completely flat because treasury bills are among the safest investments that anybody can hold. It's pretty difficult to lose money, actually, in treasury bills. And so we see that where it's a very smooth line, very low risk, but modest returns. So this chart also depicts that tight relationship between risk and return, where if you want the higher returns that come with investing in the stock market, you're definitely going to get higher risk. If you don't, if you'd rather have a lower risk portfolio, you can hold treasury bills and sort of sleep a little easier at night, but realize that your returns are going to be more modest. So getting back to what we've learned about markets, there was really an explosion in knowledge starting in the 1950s and 60s, where academic researchers in finance started to apply modern scientific and statistical methods to the market to see what they could learn, what drives returns, what matters and what doesn't, and how should investors best participate in markets. Now, it's interesting, we had to wait until the 1950s for this to kind of begin, because we had to wait for the invention of computers to be able to help with this research. There was just such a tremendous amount of price data that it was really beyond the scope of somebody doing this by hand. But once computers came on the scene in the 50s and 60s, they were able to feed all that data into the machines and ask questions and figure out what really are the drivers of returns and what really sort of makes markets tick. So a lot of this research is Nobel Prize winning, and another great thing about the research is it's all free. And so we can use what these academics have learned about investing, hopefully to help us make better investment decisions. So another kind of major finding from all that research is what drives expected returns in the market. And the top one there is one I've talked about already, which is the market factor. And that's just the factor that means if you're a stock investor versus a bond investor, that you should expect to earn a premium just for holding stocks, right? Because stocks are riskier by virtue of holding a stock portfolio, you should expect to earn a greater return than someone who just holds a bond portfolio. So that's the market premium. And that's been very significant over time. The market premium is something like 5 or 6% on average each year, sort of annualized, which represents the higher return of a stock portfolio versus a bond portfolio. So stocks have earned something like 10% over the long run, whereas bonds are closer to 4 or 5%. So that's the market premium. Now, there are other drivers of returns that research has uncovered beyond just the market premium, and they are listed here under that first market premium kind of blue bar there. One is company size, meaning that small companies have tended to outperform large companies over long periods of time, certainly not every year, but over the long run, they have. Relative price, which just means a low-priced company has tended to outperform high-priced company. And when I say low and high price, I mean relative to some accounting value, like sales, so price to sales, or price to earnings, or price to book value. So it's a relative price measure, but low-priced companies, which are sometimes called value stocks, have tended to outperform high-priced companies, again, over the long run, not every single year. And finally, that profitability, highly profitable companies have outperformed less profitable companies over time. There's some factors in fixed income or bond investing there at the bottom, but I'm going to focus my remarks on the equity market for the time being. So how big are these factors that I'm talking about? Well, they're pretty significant, and they're also pervasive, meaning they show up in markets that are not just U.S. stocks. They show up across the world in both developed foreign stocks and emerging market stocks. So we see those three premiums, size premium, relative price, and profitability, show up across markets. And they anywhere the size is anywhere between 2 to 5%. So those are potential extra return that we may be able to earn above and beyond the market premium if we structure our portfolios to capture those excess returns. So it shows that you may be able to do a little bit better even than market returns, depending on how we engineer your portfolios. Another thing to know about the premiums is that they do not show up every single year. That's true for all four. You see the blue bars represent the years that the premiums did show up, that they were positive, and the red bars are when they were negative. So if we look at the market premium, mostly you see several blue bars there at the top, but certainly not every year. If you look toward the right side of the chart, we had 3 years in a row in 2000, 2001, and 2002, where the market premium was negative, meaning that Treasury bills outperformed the US markets for those 3 years in a row. Another negative year in 2008 during the global financial crisis. And then lately there was a negative premium year in 2022. The chart doesn't show the last 2 years, but those 2 years were positive in 2023 and 2024 for the market premium. The size premium is the next one. Again, you'll see some dry spells of even several years in a row, maybe where that size premium doesn't show up, but you also see plenty of years where the size premium is quite strong and quite positive. Similar story for the value premium. There was a dry spell there kind of in the last 6 years. 4 of those years were negative and 2 were positive. And then the profitability premium has been a little more consistent. That one's been positive most years, just a couple of negative years. Another lesson that we've learned is we want to have a diversified portfolio. And that's really because diversification is our greatest tool for controlling risk in a portfolio. And there's a several different ways we can do that. We can definitely diversify regionally, which just means it's a good idea not to concentrate your portfolio in a single country, even a large country like the US, which is the largest market out there. Actually, at the end of last year, the US stock market represented almost 2/3 of the entire world's market capitalization. So the U.S. is definitely the biggest market, but that still leaves more than a third of the investment opportunities out there outside of the U.S. And it's a good idea to hold a portfolio that has these other countries, at least in some proportion, just because those countries are not going to all behave like the U.S. does. When the U.S. has a down year, many of these markets will have a positive year, and vice versa. And so you're likely to have just a smoother ride and a less volatile portfolio if you hold some of these other countries in addition to the US. And so we see that if we look at some long-term return data, and there's a lot of numbers on this chart, and we don't really need to go through them, but what we see, I guess, are two things that kind of stand out. The first is that there's really no pattern to this chart, and in terms of what countries are going to be top performers and what countries are going to be the worst performers. So each year is ranked in performance from highest at the top to lowest at the bottom, and you could just read the country names to see which ones sort of ended up at the top of that year in terms of performance and which were at the bottom. So if we want to look at this chart, I guess the other thing that stands out is where the U.S. falls. And what we see is that the United States was the top performing market only once, and that was in 2014. So if you look at the 2014 part of the chart, you see the U.S. there at the very top with a 12.7% return. But that's the only year that the U.S. was the best. Sometimes the U.S. is towards the top, like it has been at the end of the 20 teens in 2018, 2019, 2020, and 2021. Those 4 years, the U.S. was one of the best performing markets. If we look toward the left side of the chart, the first few years of the new millennium, the U.S. was actually at the very bottom of the chart, either the second worst or third worst performing market often. And all those other countries in 2003, 2004, 2006 were better performers. And so the U.S. can be toward the top and toward the bottom or somewhere in the middle. But the point is to have a portfolio that has exposure to really all of these countries, because that way you'll be guaranteed that you're going to hold at least some of those top performing markets every single year. Another lesson that the research has uncovered is that we shouldn't rely too much on past performance in terms of mutual funds and which ones have done well, and sort of basing our investment choices on trying to chase the high performing funds, because as it turns out, that performance does not tend to persist into the next period. So if we look at, say, a 5-year performance period, and we just sort of select the mutual funds that were in the top 25% of performance for the prior 5 years, and then we look at how those top performing funds do in the subsequent 5-year period. What we see is that only 22% stay in that top quartile of performance. So it means that even among the best performing funds in the next 5-year period, almost 4 out of 5 do not stay in that top quartile of high performance and end up moving down in performance. So you can't really base your investment decisions on what the managers were able to achieve in the past, because it may not persist, and market conditions may change, and so their strategy may no longer work in the next 5-year period. Another lesson, and this is a difficult one, is to try not to invest with our emotions. And it's difficult because, as human beings, we all have emotions, especially fear and greed, when it comes to our investments. And it can be hard to turn that off, because it's only natural to feel better about markets, maybe after they've gone up, or maybe after the economy is doing well, and we see a period of strong growth and maybe low unemployment and good stock market returns. It can feel like it's a good time to invest more money in the market when it's done well. And the same thing is true when maybe the market has not done well. Maybe the economy is weakening, maybe there's a threat of recession. It can feel like maybe we should pull back on our investments and maybe take some money out of the stock market and put it in something safer. That is sort of a natural instinct, but it may not be the best in terms of timing, as far as the greatest potential for risk and the greatest potential for opportunity. That often sort of does not coincide with sort of our natural human emotions. And so we should try not to invest with that if at all possible. And so we kind of see the consequence of that, again, borne out in the data. If we look at the performance of an index that represents US equities, and then compare that performance over time to what the average stock investor was able to achieve, there's a big gap there. So from 94 through 2013, the S&P 500 was up 9.2% per year. If we look at what the average stock mutual fund investor actually achieved in terms of their personal return, it was only 5%. So there's a huge gap there, which really adds up over time, more than 4% per year. The biggest explanation for that gap is poor timing decisions. So it's getting out of the market after it's gone down, and then waiting until after it's gone back up for a while to get back in. So by doing that, you miss out on a significant amount of returns, and it would probably be better just to hold on through the dips, through all the ups and downs over that entire period. You're just likely to have a better investment experience by doing that. Another lesson is to diversify your portfolio effectively. So I talked a little bit before about regional diversification. So you want holding multiple countries in your portfolio. You also want to hold different kinds of assets. So diversifying across security types in your portfolio is also a good idea. And you definitely want to diversify effectively. So if maybe you have multiple assets in your portfolio, but they may possibly all go up and down at the same time, which really isn't going to help. That's not really effective diversification. We want to try to build a portfolio that has assets that move up and down at different times. When one does well, maybe the other one's not doing so well, because you're likely to have a much smoother ride overall. Lower volatility in your portfolio will hopefully help you hold on to your portfolio for the long run, and try not to make market timing decisions and try to trade too often because of high volatility. So we want to diversify effectively across different security types. And that might be a little easier said than done, but one of the most effective and simplest ways for a stock investor to diversify their portfolio effectively is to just add some high quality short-term bonds. And so I'll use 5-year treasury bonds as an example here. If you add a proportion of your portfolio to treasury bonds, these are very effective diversifiers because in most periods, they tend to do quite well when the stock market hits a speed bump and is not doing well. We see that in a couple of periods here very strongly. If we look at, say, the first few years, again, of the 2000s, 2000, 2001, 2002, those were not good years for the stock market. We had negative returns all 3 years in the US, but 5-year government bonds did very well all 3 years. Two of those double-digit positive returns. So that definitely would have helped kind of cushion the blow in a portfolio during that time. We saw it again in 2008. So as the global financial crisis was unfolding and stock returns were deeply negative, the U.S. market fell 50% that year, actually a little bit more than 50%. And 5-year Treasury bonds had a very strong year, up 13% in 2008. So that would have been a really nice asset to hold during that time frame, because it would have really cushioned the blow in the portfolio. And we also see the opposite, like when stocks have a really, really good year, we can look at, say, 2004, 2005, stocks are pretty strong. And we see 5-year government bonds at the bottom, still a positive return, but just a lot more modest at 1 or 2%. But again, acting opposite of stocks and being a really good diversifier. We also should do our best to try to ignore the headlines that come out from the financial media. I mentioned this before, that if we watch a lot of financial media, you're going to have the feeling maybe that we just sort of lurch from one crisis to the next, and have the feeling that there's always a reason not to be fully invested, some reason that we should not be invested at the moment. But these crises tend to come and go, and the market may or may not react strongly to what's going on at the time. But over time, the market does shake these events off and go on to make new all-time highs. It's continued to do that for decades and decades, and we just kind of have to trust that that's going to continue, because again, trying to time the market, trying to get in and out is very difficult to do on any consistent basis. And again, it's probably better for your investment experience to just kind of tune these headlines out and ignore the noise and just kind of hang on and just have again, a good plan and a good philosophy that you can stick to. Lastly, we should focus our attention on the things that are under our control. Some things are and some things aren't. One thing that's not under our control is what the markets are going to do. So as much as we might like to have control over market returns, we really don't. We have no control over what the markets are going to do in the short run or the long run. But there are many things that are under our control. And one is to create an investment plan with an investment philosophy that you believe in, and one that fits your needs, your goals, and your risk tolerance. We can do that. We can structure our portfolio along those dimensions of expected returns that we talked about before, have some exposure to the market factor and the size factor and the value and profitability factor, because we may be able to have slightly higher expected returns that way. We can diversify globally and effectively. We talked about that. We do have some control over managing expenses and investment costs. The cost of investing is coming down over time, so that's good news for investors. Trading and transaction costs, management fees have been coming down. But we want to pay attention to those and make sure we're not overpaying for our investments. And especially, we want to make sure that we have tax-efficient investments. And that can involve sort of where we place certain investments and how we manage capital gains and losses in a portfolio. These are things that are under our control. And then finally, we should try to stay disciplined through market dips, because markets, like I mentioned at the beginning, we're definitely going to have drawdowns. We're going to see that every single year. And so we should just kind of expect that and have a plan for what we're going to do or not do when we do see drawdowns in the market. We actually just had one in the last few weeks where the S&P 500 briefly dipped down to about 10% drawdown from all-time highs. Totally normal and expected. We see that every couple of years. So we just need to realize that drawdowns are expected, even though the timing is not predictable for those market dips, and just sort of know ahead of time what we're going to do and how we may or may not react to those dips when they occur. So that is all I have today. I will end it here and see if we have any questions.
Thank you so much, Rob. I love those slides that you showing the importance of diversification. That really, it's such a great way to illustrate that. We do have a couple questions. One is, what do you mean by the cost of investing is coming down? And then you said how we should manage our expenses. How can we do that?
Sure. So the overall cost of being a retail or just a private investor has come down a lot over the decades. So one of the biggest changes has been in brokerage commissions. If you were to trade a stock back in the 60s or 70s, you would have paid a very high commission rate on every single trade. Whereas most brokerage accounts today have free trading, especially for exchange traded funds or individual stocks. There may still be some fees involved in certain mutual funds, but a lot of trading now that retail investors can do is costless in terms of the buying and the selling. And then as far as how we can help control our own costs, that's where what we want to do is review what the built-in management fee is on the investments we're going to make. So if we're going to buy a mutual fund, for example, or an exchange traded fund, they all involve some fee for management, right? There's going to be professional managers that are buying and selling within that fund. There's a cost to that, and even though those costs have come down overall, you can still find both very expensive funds and very inexpensive funds. So when I say it's under our control, I mean we can control what we select for our own portfolio and which funds that we choose to invest in, and make sure that the costs are reasonable.
Excellent. That makes sense. What's been the most surprising thing to you in the last year when it comes to the markets? And then how did you advise clients to handle it?
Well, I haven't recommended any changes because I think what we've seen so far is just a sort of typical market behavior. So it actually has not been too surprised. I'd say if there was a surprise, it was how strong the markets have performed in the last couple of years. In 2023 and 2024, we had back-to-back years where the U.S. stock market had more than a 20% return in each one of those years. So that's kind of surprising because we don't normally see returns quite that high. And so in the last few weeks to see a 10% pullback, completely normal, expected, not strange behavior at all. So that's been a little surprising, just how strong the markets have been, and that coming into if I just could name one more surprise, if you can think back a couple of years when the Federal Reserve was raising interest rates very aggressively at the end of 2022 to combat the inflation that we saw that year. It was surprising that the markets handled that so well, and that we actually did not go into recession. A lot of people were predicting a recession in 2023 because they didn't think the economy could handle interest rates going from 0% to 5% so quickly. But the economy was able to shake that off, and the markets had very strong returns. So that's been another surprise.
Yeah, just goes to show you can't predict everything, right?
That's right.
Well, thank you so much for your time today. You're always so wise and helpful to our clients, and we continue to learn every time you speak. So thank you so much, Rob. Our next webinar will be April 15th. Not our favorite day usually, but we will be hosting a webinar about behavioral finance. And Rob touched a lot on that today about how your behavior can affect your portfolio for the good or the bad, but we'll explore that in more detail next month. Thanks so much, Rob.
All right. Thank you.
All right. Have a great day, everybody.
Bye.
Bye.